from now. But let's welcome in Rajiv Batra, who's head of Asia and co-head of Global Emerging Markets Equity Strategy, Chief India Equity Strategist at JPMorgan. Rajiv, good morning. Great to have you with us here. Thank you for your time. The question is about flows, Rajiv, and FII flows, for all the bluster sometimes that we get, do matter because locals have been big buyers, some $55 billion YTD. FIs have sold about $13.5 billion YTD, and of course, we know what the market's done, right? Or not done. What are the 2 or 3 important determinants from here which will tell us or mark the return of foreign money in a sustainable way? Is it valuations? Is it something else? Rajiv, go on.
Thanks, Prashant. Thanks for having me over here. I'll say only one variable is important: growth. And I have said on your channel in past also, foreign investors are growth tourists. They invest in the destinations that offers them premium growth. Till India was offering them, India was all in favor. Now, even if I will say that, absolute sense, India valuations are expensive, but in a relative terms, looking at average valuations of India to emerging markets or other EM peer, we are well below the average ranks of that premium also. Still, people will not visit because the complaint will be that PEG ratio of countries still not around 2 or below 2 kind of a mark. So only one variable which is important is growth. And hence you can see in flows. Flows, if you take the passive guys out, because in 13 billion, close to 8 billion has come from the passive side in India, net inflow. Active guys have seen close to $21 billion kind of an outflow. So growth is a key ingredient for active foreign fund managers to make a comeback.
Okay, and what? So you're talking about earnings growth, Rajiv, right?
Yes. It will start with your high-frequency macro growth data points, which are your monthlies and weeklies, and then followed up with the earnings data print. We have a pretty good high single-digit earning growth for MSCI India for first quarter FY26, but that doesn't still bring India's PEG ratio to close to 2. So once we come around the territory of 2, that is around 12 to 13% earning growth kind of a criteria, it may satisfy my foreign investors' need.
Just one clarification, that flow number that you mentioned, could you just repeat that? I said $13.5 billion out of India from foreigners, and then you said passive and active.
Passive and active.
That was in the... Sorry, go on.
Yeah, the passive and active divide is net inflows in India through passive route is 8 billion, and net outflows are from active side is $21 billion.
Okay, that's a big one, and that tells you a lot as well, right? That active managers have been going elsewhere, where perhaps earnings growth is higher, or maybe tactically, it's just a better play because of valuations. We know that, Rajiv. We've seen that South Korea has been a market well loved. There's been money going into China as well. The question is, when does it reverse? Now, you said 12 to 13% earnings growth. What is the visibility you have in the future? Do you see that happening? We got a ratings upgrade from S&P. For instance, S&P is saying this whole US tariff business is not going to impact India too much. So when do you see us getting to 12 to 13% earnings growth?
So first of all, on the rating upgrade, market participants believe it is a belated one, but I'll say it is still it still signals a positive shift in perception of India economic strength and stability, which matters a lot from long-term perspective when you take into account borrowing cost and the risk premia for country. Remember, it has been declining from 4.5% a decade back to now almost 2.5%. It can slide down further from here and supports India valuations in future. Now, what could bolster the earning growth and GDP growth? I believe catalysts are getting unleashed one by one. Like, let's take into account monetary policy, which have been in complete drive from November last year. We have seen cumulatively 100 basis point repo rate cut, 150 basis point CRR cut, and now fiscal has started giving full push. Remember, this is not just something new we have seen from fiscal side. Almost for a year, consumption has been getting boosted by fiscal measure, like first by subsidies, then followed by tax cut for middle class, and now this potential GST tweaks. So the twin policy tightening, which was in play in India till November last year, have now shifted towards safely to twin policy easing. So give it a quarter now from here, or max 2 quarters. Expect your double-digit 12 to 13% growth handle will appear on Indian equities.
Oh, okay, that sounds good. Just 1 to 2 quarters and we get back to double-digit growth. I think the bulls will love the sound of that, Nigel.
Well, that's right. Hi, Rajiv. Good to see you. Then what are the sectors that you're most bullish on? Because the globe is still a very sticky place, but it appears India is set to give up its underperformance. Last 1 year, we have underperformed. The earnings have been weak. Some domestic factors as well have been soft. Let's talk about the largest constituent. That's the banking names. What's your view out there? How do you approach it? There have been some kind of pressure in terms of asset quality. Credit growth as well has been soft, but the optimism is that we'll gradually see a pickup in credit growth. Your take, and what do you like from there?
No, so definitely when you are doing this much amount of an easing as per economic concept, what we have learned and what we have seen in the previous cycle also, that it may take 2 quarters, it may take 3 quarters, but usually credit growth start appearing post the start of the monetary policy cycle easing with this much amount of a lag. Taking that into account, it will be unfair to assume that we will immediately go towards 18, 19% kind of an handle. Because remember, when the two big institutes got merged, at that point of time, the structural credit growth of the country brought down from 16.5 handle to 12.3%. So if we scale back to 11 to 12% kind of a zone also, it will be very healthy scenario overall. And remember, as I've said, the big part of India credit growth story for the last 5 years or maybe decade have been consumer. Because of excessive tightening, or you can say higher risk weightages and stuff, that particular zone start getting impacted. But now with the easing coming into the picture, even reductions in the risk weighted norms or provisionings also will try to spur up credit growth initially from that end. And once because of that consumption comes in picture, you will start seeing demand from corporate also, maybe led by working capital need or even by the Capex related need. So it's kind of a cycle which got stopped, and maybe we are kick-starting the new cycle over here as such. But all in all, we are very gung-ho on financial space, and particularly private banks and non-banking financial companies.
Got that. Is there a way to make up, or actually let me ask you another way, for foreign investors that you advise, interact with, is this India, US, and what has happened there with regards to relations, etc., ever come up in conversations? In what way, shape and form? Obviously, this additional 25% tariff is not, even if it goes into effect from the 27th, it's not going to be permanent. I mean, it'll be negotiated lower. But does that come up, and in what way, Rajiv?
No, so most of the time, the geopolitical uncertainty comes off the investor's mind whenever it starts hitting the headline. But if you look from the last 20, 30 years perspective also, it has rarely derailed the long-term trajectory of Indian equity market. Usually this kind of a volatility ends up as an opportunity to accumulate the quality stocks. Now, the question that comes from investors are that how this equations will impact the growth. Now, I do agree, whether it's a political equation or a trade, along with the capital flows, interact with the growth from external demand perspective, because this external demand has been the key driver for India GDP growth from 2019 to 2024, rather than the private consumption. Now, suddenly, if this factor starts slowing down, you need extra growth boost coming from the other side, which is your domestic demand and private consumption. So till you don't see a resolution around the corner on that particular conversation, I think most of the burden for driving growth will be taken on the domestic end. But I do believe, like near term, we should not get too concerned about if this situation persists for longer, how we could be impacted. Yeah, number one will be the risk premium, which we have enjoyed due to the geopolitical diplomacy and got the risk premium of 2.5% from 4.5-5 territory. That can scale up back if the situation persists for a longer time, or the trade and the capital flows for country start getting impacted. But too early to say, because the situation is still evolving.
Rajiv, finally, from a thematic perspective of just building a portfolio for the next leg of the bull run, if I may say, I mean, if this is still a structural bull run in India, should that portfolio be more geared towards consumers? And this is a play both on obviously earnings and also valuations and tactical call. should it be more geared towards a revival in consumption and therefore consumers? Or should it be more geared towards industrials and Capex, which was the case? I mean, those were the earlier leaders of the previous cycle.
No, the thumb of the rule in emerging market is you invest as per what your policymakers are guiding you towards. So since February, we have seen the pivot has been made towards consumption side from Capex. And right now we have seen, even with this GST tweaks, it will be more favorable for consumption. And rightly so needed, because as I've said, if external engines are slowing down, like JPMorgan estimate close to 1.6% GDP growth only in US. So even if the tariff concern resolve, external demand is not gung-ho overall. So taking that into account, domestic demand will be the play, and how you play the domestic demand, where maximum support you are getting your policymaker towards consumption side. So we pivoted towards consumption over Capex in February last year, and we are still reiterating that. And the broad overarching theme, not just, I will say, within India, but emerging market with the global growth slowdown upon us, is domestic demand over exporters. So more you position your portfolio towards domestic demand, like financials, staples, discretionary, real estate, hospitals, and maybe some of the material plays which are purely dependent on domestic demand, that will help you generate a high return and maybe even outperformance to your regional peers.
Okay, all right, Rajiv, we appreciate you joining in and giving us all of those details. All the best, and hopefully, as you said, things will recover from here on. Positive measures being taken both by the centre as well as the RBI, and those results will be seen in the coming quarters.
Thank you.